Hey everyone, welcome back to another exclusive podcast from IronFX, where we're dedicated to bringing you the absolute best education to help you take your trading to the next level. I'm your host Desmond, and today we break down the latest decision from the US Federal Reserve and what it means for markets, the economy, and your pocketbook. For the next few minutes, we'll explore why the Fed is standing pat on interest rates and what's behind its cautious approach toward future rate cuts. On June 18th, the Federal Reserve's Policy Setting Committee unanimously voted to keep its benchmark interest rate steady, maintaining the target range at 4.25% to 4.5%. This marks the sixth consecutive month at this level, reflecting the Fed's ongoing effort to balance its dual mandate: maximum employment and stable prices. The decision wasn't a surprise, right? Economic growth has slowed to a projected 1.4% for the year, and inflation, while down from its 2023 peak, is still running at about 3%, well above the Fed's 2% target. The labor market remains resilient with low unemployment and steady job growth, but policymakers are watching closely for signs of stress. Fed Chair Jerome Powell set a measured tone at the post-meeting press conference. He acknowledged that inflation has moderated but remains somewhat elevated, and he pointed to new uncertainties, especially the impact of proposed US trade tariffs. Powell emphasized that while the labor market is strong, tariff-related price pressures are starting to emerge, and the Fed cannot assume these will be temporary. Here's how Powell put it. We are beginning to see some effects of tariffs, and we expect to see more. The inflationary impact of tariffs remains highly uncertain, dependent on both their ultimate level and duration. This uncertainty has led the Fed to adopt a wait-and-see approach, holding off on rate cuts until there's more clarity on inflation and the broader economic outlook. Despite holding rates steady, the Fed's latest projections, the so-called dot plot, still suggest 2 rate cuts are possible later in 2025. However, the outlook for further easing in 2026 and 2027 has been pared back, and more policymakers now expect no cuts at all this year compared to just a few months ago. This cautious stance reflects the Fed's priority: avoid cutting rates too soon and reigniting inflation, especially with tariff-driven price increases looming. As Powell noted, the timing and extent of any rate reductions will depend on incoming data and how the economy responds to both inflation and trade policy shocks. The Fed's cautious messaging prompted traders to scale back their expectations for imminent rate cuts. Treasury yields edged slightly higher, reflecting reduced hopes for near-term easing. Interest-sensitive sectors like real estate, small-cap stocks, and speculative tech continued to underperform as the prospect of higher-for-longer rates weighs on borrowing costs and valuations. The Federal Reserve is holding its ground, signaling that while rate cuts are still possible later in the year, it's in no rush to ease policy amid persistent inflation and fresh uncertainty from trade tariffs. For investors and consumers, this means continued vigilance. Borrowing costs will likely stay elevated, and the path to lower rates will depend on how inflation and the broader economy evolve in the months ahead. We'll keep watching the Fed, the markets, and the data so you don't have to. That's all for today's episode. Thanks for tuning in, and in the meantime, do remember to subscribe to our podcast here at IronFX, where we're dedicated to bringing you the very best education to take your trading to the next level. Until then, stay informed and stay tuned.